Today's video will be all about taxation stuff that revolves around the stock market. How much tax get deducted from your gains and many other questions are gonna be answered. So let's begin. Assuming you made some money with stocks, well, now you need to be taxed on the money you made. So today I'm going to give you guys the 6 biggest points on taxing that every single stock market investor should know. Anybody that's thinking about investing in the stock market should know to plan out his investments accordingly on what he buys. You need to know things like stock which you sell, what will be the best investment for you, all because the tax rates are different for different things, and it's very important to understand. That way you can plan accordingly. So the majority of investors will be taxed on dividends at a 15% tax rate. A 15% tax rate that most people know comes for a super high income, which is around $400,000, above which you'll be taxed at 20%, where regardless the dividend tax is generally going to be way less than what you are paying as a normal tax person. It's a big advantage to basically invest in dividend stocks and stocks that pay you dividends, because basically you're taxed way less than you would be if you were actually making that money yourself. This is what Robert Kiyosaki talked about in his book Rich Dad Poor Dad. Being an investor is a great thing because you are taxed a lot less than guys of other sectors. That includes self-employed, professionals, business owners, or employees, which is awesome. Dividends are taxed at 15%, whereas income people are taxed at 20%. Adding to it, if you held a stock for less than a year and sold it for a profit, then you are going to be taxed at your normal income rate, which can be as high as 28% depending on your income bracket. Which means if you made a $1 profit from a company stock, about 28 cents would be deducted as taxes. But here is the real plan. What if you wait for a year to pass? Let's say you hold it for 370 days, and now when you sell the stock, assuming a $1 profit, you will be taxed about 15%, which means you pay 15 cents only. This might not make a difference now, but when numbers add up, they get massive. For example, let's say you made a $200,000 profit in stocks and sold it before a year passes. As per capital gains rule, you will be taxed $30,000, but holding it for a little more than a year could save you $26,000. Now it makes sense. And then the compounding effect, the extra $26,000 then invested next year and you get a certain return. And then the next year, and the compounding effect snowballs over decades. It gets massive and massive. There are a million other reasons to play the long-term game, as it is so advantageous and ends up being a win-win situation for the investor. So being a long-term investor rather than a short-term trader is highly advisable, because even if a short-term trader makes big money after lots of hard work and analysis, he'll end up paying a big amount of his profit as taxes, which is less rewards after great efforts. However, if he focuses on being a long-term investor and holds the stock for a long time, he would be taxed just 15% on the profits alone, and the rest of money will keep snowballing and piling up again and again over the decades, making him wealthy in real sense. Next tip would be, if you sold the stock for a lot, you can write it off against any stock gain you suffered that year. But you can't write a stock that walks off against a normal income or something that does not matter at all. Let's say you lost $5,000 in stock this year. Now you can use that $5,000 loss as benefit by writing it off and get concession on taxes. If say you made another $10,000 in some other stock game. So in reality, it's just going to be a net $5,000 gain you had in that very year, because you can write off that $5,000 loss against the $10,000 gain you made. I hope you're getting it. Adding to it, you must also know that the write-off becomes possible when A, you actually took losses in the stock, and B, it could be written off against capital gains profits made on stocks and investments only. Keep that in mind. Up next is, watch out for a wash sale. Wash sale is a sale of security at a loss and repurchase of the same or substantial identical security shortly before or after. Basically, you can't buy or sell a stock within 30 days, because otherwise cunning people out there could go ahead and sell a stock for a low price and try to take a loss on that and then come back and buy it again a week later. In short, they would be outplaying the system. However, the government does not allow that anymore. They kind of got smarter too, as they do not let that happen because a lot of people were taking advantage of this loophole. Basically just selling a stock, taking a huge loss on it, and then going ahead and buying it back. This is a totally no-no. You can't do that because it's an unfair advantage you seal. So that's when a wash sale is not a lot of people understand. But sometimes I see people buying a stock back within a 30 days period. You just go back to your old cost basis, so you're not going to take a gain or a loss. Alright, now before ending this video, I would like to add a point. You guys should start using tax calculator. That is just a Google search away. Using these tax calculators would help you get a basic idea of what your taxing number would look like in later phases of the year, and you would stay updated with those numbers. This will help you greatly when the day of filing the taxes finally comes. If you file it yourself, you would be aware of where you can appeal for a refund and stuff like that. Or you can just hire a professional for that, which might make things easier. However, it's always nicer to know more about your business. Well, this was it for the video. Hope this video helped you guys. If it did, please consider subscribing to our channel. I'll meet you in some other valuable video. Till then, keep hustling.